Thank you, Alok, and thank you everyone for joining us here today. I'm excited to be here with you for my first earnings call as interim CEO. I've served as a director on HP's board since 2021, and I, along with my fellow board members, strongly believe in the management team and strategic direction we are charting at HP. I'd like to also acknowledge Enrique Lores and his contribution to the success of the company during his 36-year tenure. We are sincerely grateful to him. The board and I are committed to strong stewardship, including disciplined decision-making, operational consistency, stability for our employees, and delivering value for our customers and shareholders. With that in mind, I want to provide a brief update on the CEO search. The process is well underway. The board's priority is to identify the right leader to guide HP through its next phase of evolution. We will consider a broad range of candidates with a preference for proven executives who have successfully operated large multi-segment business in a complex and dynamic environment. During my first few weeks since we've announced the CEO transition, I've immersed myself in the company. I've met with thousands of employees and spent considerable time talking with customers and suppliers. I've also had the opportunity to work closely with the leadership team. I want to thank the employees, suppliers, and customers for the warm welcome. Together, these discussions give me a clear view of the opportunity ahead and the deep confidence in what the organization can deliver. We are at an exciting inflection point in technology where customers need a trusted partner to enable edge computing, simplify experiences through integrated solutions, and embed AI into products that proactively anticipate users' needs. This is the foundation of our future of work strategy, which positions us to expand market share and ensures our pricing reflects the value we deliver, especially as we navigate near-term challenges. We will stay disciplined in executing our fiscal 26 plan, which you will hear more about today, taking great care of our customers, partners, and suppliers, and continuing to build a company where people are proud to work and grow. I'm working directly with the talented HP leadership team to ensure we are actively managing every lever available to us to drive value creation. With that, let's get into the quarter. Overall, we executed well in Q1 and made solid progress against our strategy. Karen will cover the details shortly, but let me highlight a few points. We delivered another quarter of steady top-line growth with revenue of $14.4 billion, up 7% year over year, driven by performance in personal systems, as we continue to see the positive impact on PC demand from the Windows 11 refresh cycle and the continuing momentum of AI PCs. We achieved PC market share gains across our high-value commercial and consumer categories, contributing to our double-digit revenue growth in the segment. In print, our results were in line with expectations, with continued momentum in consumer subscriptions, which grew revenue double-digit, and industrial print, which grew mid-single-digit, with continuing shifts from analog to digital production. We prioritized the placement of profitable units and grew big tank share in developed markets. Non-GAAP EPS of 81 cents reflected 9% growth compared to the prior year and was at the top of our guidance range. Turning to our strategic advancement highlights, HP is dedicated to creating a more fulfilling professional experience. In the first quarter, we made meaningful progress bringing AI to the workplace through innovation. HP's focus on AI at the edge reflects the increasingly critical role of this technology in the daily lives of our customers. As the AI curve moves from an experiment to scale deployment and measurable returns, we are enabling customers with compute power to run powerful large language models locally, complementing AI in the cloud with secure, high-performance, in cost-effective AI at the edge. This is an important part of our future of work strategy. This quarter, AI PCs accounted for over 35% of our PC shipments, up from 30% in the prior quarter and 25% the quarter before. We also launched the HP Elite Board G1A. This is the first AI PC with intelligence built into the keyboard for hybrid work, and it's just one example of how we are bringing on-device architecture to life. In print, our new AI-powered scanning and redaction capabilities are now reaching customers, simplifying workflows and reducing friction for small business. Our focus on delivering more secure and AI-enabled print experiences is also being recognized, with industry analyst Circa recognizing our leadership in AI-driven print solutions. The next step in our strategy is driving better together experiences. We believe there is enormous value in integrating devices, software, and services to work as a unified experience. In the first quarter, we launched HP Digital Passport, a personalized hub that centralizes information across the full HP ecosystem, resulting in better customer engagement and more efficient support. We also expanded our partnership with Microsoft, embedding Microsoft 365 Copilot directly into HP printers to improve how employees manage documents on the device. This brings us to our third step, empowering CIOs with tools to gain actionable insights, manage risk, and run IT more strategically at scale. To that end, we introduced multiple enterprise-focused updates in Q1, expanding our workforce experience platform, commonly called WXP, capabilities to further simplify device and printer management, combined with reducing downtime. WXP is now the most comprehensive multi-vendor fleet management solution across PCs, print, and collaboration. By taking in data from 50 million endpoints and processing more than a terabyte of data daily, the platform enables predictive insights that allow IT teams to proactively identify issues, streamline operations, and improve workforce productivity. In addition, this month, HP established an exploratory partnership with OpenAI to pilot OpenAI Frontier, their new enterprise platform for building and managing AI agents. This puts HP at the forefront of enterprise AI deployments with built-in governance, security, and observability as we move from pilots to scaled adoption across workflows. In March, we will host our HP Imagine event for industry and media analysts. This showcases our latest innovative solutions to help people do their best work from anywhere. The new experiences we unveil at HP Imagine will demonstrate how we continue to lead the future of work by helping customers drive growth, professional fulfillment, and foster innovation in the era of AI. Now, let me touch on the rising memory cost environment and how HP is addressing these market challenges, which are impacting companies across the technology sector. Like others, we are seeing increased input costs driven primarily by the rising prices of DRAM and NAND. We expect this volatility to remain throughout fiscal 26 and likely into fiscal 27. While we believe the market will rationalize over time, we have already been implementing a number of mitigation measures. And since I moved into this role, I've been actively working with the team to drive these actions forward, make adjustments where needed, and bring as much of the memory dynamic as we can under our control. To get a bit more granular on these mitigation measures, let me focus on progress of our key strategies. First, on the supply side, we have leveraged the strength of our supplier relationships and secured long-term agreements covering our memory requirements for fiscal 26. We've qualified new suppliers, built in strategic inventory positions for key platforms, and cut the time to qualify new material in half to accelerate our product configuration changes. Second, on the cost side, we've expanded lower cost sourcing across our commodity basket, lowering logistics costs with agile end-to-end planning processes as part of the company-wide AI-enabled program. And we've accelerated company-wide productivity efforts as part of this program to use the company-wide broader cost base to execute offsets. Third, at the same time we are implementing strategies on supply and cost, we are also configuring our products and shaping demand to align the supply we have with our customer needs. And we are taking targeted pricing actions to offset the remaining cost impact in close partnership with both our channel and direct customers. We have a strong track record of managing through commodity super cycles and uncertain times. We've demonstrated this during the pandemic and more recently through trade cost uncertainty. We built a more resilient supply chain and leveraged our strong brand and distribution strength to gain share and expand margins. HP is also well diversified, with a meaningful portion of our personal systems profit coming from services and peripherals. While the near-term environment will remain challenged and pressure PS margins, we are confident the actions we are taking will position us for the long-term success. I also want to touch briefly on last week's U.S. Supreme Court ruling on tariffs. We are evaluating the impact of the decisions, including the announcement of new tariffs in the last few days. Right now, we do not expect to be negatively impacted by the subsequent developments following the court decision. However, we will continue to engage the administration on these matters and others. We are confident in the strength and agility of our supply chain, which provides the flexibility needed to navigate an uncertain trade-related cost environment. In this fluid operating environment, fiscal 26 will be shaped by a range of factors, some of which remain uncertain. Our focus will be on prudent execution of mitigation plans to offset the impact of memory costs, accelerate company-wide cost action, and continue to execute against our future of work strategy. We expect that the memory situation will normalize at some point. In the meantime, we are not backing away from our long-term commitments despite headwinds. And my focus is to ensure we continue to move forward with urgency and discipline without missing a beat. Before I close, I want to say what an honor it is to be part of the HP team. This is a special company, and I have great respect for our mission, culture, and people. To our shareholders, thank you for your continued belief and confidence in HP. And to our employees around the world, thank you for your dedication and commitment. And I'm proud to be on this journey with you. And lastly, I want to provide an update on the Investor Day we had planned for April. In light of our ongoing CEO transition, we will be rescheduling this and look forward to sharing a date with you at the right time. I'll now hand it off to Karen to walk through the first quarter results and outlook for the remainder of the year.
Thank you, Bruce, and good afternoon, everyone. We are pleased with our first quarter results and the solid progress we made on delivering against our financial commitments. We drove better than expected top-line growth, fueled by continued refresh momentum in personal systems and in our key growth areas. We also delivered non-GAAP EPS at the top of our guidance range. In a dynamic environment, our teams executed well, making progress on the playbook we laid out at the beginning of the quarter to mitigate higher input costs. As you heard from Bruce, our initiatives are focused on securing supply, shaping demand and product configuration, implementing targeted cost reduction, and taking pricing actions. And all of these are well on track. While the memory situation remains fluid, we are executing well on all of the levers within our control and will continue to do so in the quarters ahead. Now let me walk you through our first quarter performance. We delivered revenue growth of 7% year over year, up 5% in constant currency, with growth across all regions. Strength in personal systems drove APJ revenue up 13% in constant currency, with EMEA and Americas growing 5% and 1% respectively. Gross margin was 19.6%, reflecting an increased mix from personal systems, as well as higher commodity and trade-related costs, offset in part by pricing and cost reduction actions. We drove non-GAAP operating expenses down year over year through strong expense management and the continued benefit from our Future Ready cost savings program completed at the end of fiscal year 25. All in, our non-GAAP operating margin was 6.9%. Below the operating profit line, lower net financing expense and lower currency impact contributed to better than expected non-GAAP other income and expense in the quarter. And with a diluted share count of approximately 932 million shares, our non-GAAP diluted net earnings per share was 81 cents, up 9% year over year. Now let's turn to segment performance. We delivered better than expected top-line growth in personal systems, with revenue up 11% on 12% unit growth, with continued momentum in Win 11 refresh, AI PC adoption, and particularly strong consumer performance. We outperformed the market and, consistent with our strategy, gained share in premium categories. We also drove strong performance in key growth areas, including AI PCs, advanced compute solutions, and workforce solutions. In consumer, we delivered 16% revenue growth on a 14% unit increase, above our expectations. We attribute part of this above seasonal performance to demand pull-in aimed at avoiding the impact of rising memory prices. At the same time, we drove increased ASPs while delivering share gains in premium consumer devices. In commercial, we drove 9% revenue growth, with units up 11%, fueled by Win 11 refresh, particularly in EMEA, and AI PC strength. While we increased prices to help offset rising memory costs, we also had some large education deals in the quarter that impacted ASPs. Consistent with our future of work strategy, we gained share both year over year and sequentially in commercial premium categories. Our operating margin in personal systems was 5%, within the range we guided at the beginning of the quarter, but slightly below expectations, given the stronger than expected performance in consumer and education. In print, our results were in line with expectations, with improvement in the rate of market decline. Revenue was down 2% on lower supplies volumes and market-driven hardware declines. Consumer revenue was down 8% year over year, and commercial revenue down 3%, with higher ASPs helping to offset lower volumes. Supplies performed as expected, down 2% year over year in constant currency. We continued to gain share in supplies while increasing pricing to partially offset installed base and usage headwinds. We delivered solid performance in our key growth areas. Consumer subscriptions grew double-digit year over year, helped by the continued ramp of our all-in plan and reflecting our focus on increasing lifetime value per customer. Strong demand in drones and robotics drove double-digit growth in 3D, and industrial print revenue grew for the 10th consecutive quarter, driven by the continued transition from analog to digital. And in line with our guidance, we delivered an operating margin of 18.3%, within the upper half of our long-term range. We are making solid progress on our initiative to embed AI into our processes to accelerate product innovation, improve customer satisfaction, and boost productivity. For example, we are working to integrate AI into our channel partner experience through a digital teammate that will answer questions, act on queries, provide integrated workflows, and proactively guide next steps. We are also scaling additional AI agents in supply chain to automate order entry, sales returns, and product data management. We remain on track to generate approximately $1 billion in gross annualized run rate savings by the end of our fiscal year 2028, and are actively working to accelerate and scale these initiatives. These important efforts enable our continued investment in key strategic and go-to-market initiatives aligned with our future of work strategy. Now let me move to cash flow and capital allocation. We generated close to $400 million in cash from operations and roughly $200 million in free cash flow in the quarter, in line with our expectations and reflecting typical seasonality. And we improved our cash conversion cycle sequentially on favorable linearity, offset in part by higher days of inventory reflecting rising commodity prices. On capital allocation, we remain committed to returning approximately 100% of our free cash flow to shareholders over time, as long as our gross leverage remains under 2 times and there aren't better return opportunities. In Q1, we returned over $600 million to shareholders through both dividends and share repurchases. While our leverage ratio remains slightly above target in Q1, we have maintained increased cash balances, reserving sufficient funds to pay down 2026 debt maturities, which enabled us to buy back shares in the quarter. And if needed, as we move through fiscal 26, we can operate with higher cash balances to further reduce leverage with maturities in fiscal 27. As we look ahead, we have contemplated the dynamic memory environment highlighted earlier, as well as the associated mitigation actions we are taking. These include expanding pricing actions and implementing additional company-wide cost reductions. And as Bruce mentioned, we are evaluating last week's U.S. Supreme Court tariff ruling and the subsequent developments, but at this point do not expect to be negatively impacted. Looking at our outlook by segment, in Personal Systems, we are aligned with industry experts now projecting the PC unit TAM to decline double digits in calendar year 26, reflecting the impact of industry-wide pricing actions on demand. Against this backdrop, we continue to expect to drive revenue growth in our fiscal year through pricing actions, share gains in premium categories, and increased attach of higher margin offerings. We expect above seasonal revenue performance to continue in our fiscal Q2, driven largely by the pricing actions we have taken, with revenue growth then moderating in the back half of the year. Considering the continued fluidity of the commodities market, we are modeling a range of outcomes that factor in memory prices that are roughly doubling versus the prior quarter. Given this, we now expect the PSOP rate to be below our long-term range for the remainder of the year, reflecting this additional cost pressure offset in part by mitigation actions. In Print, we continue to expect the hardware market to decline low single digit in calendar 26. Yet we expect to drive growth in big tanks and industrial print to help offset. We are continuing to execute against our plans to gain share in big tank and office and to drive further momentum in key growth areas, expanding our subscription business and driving growth in industrial. While we continue to anticipate supplies revenue to be down low single digit for the year in constant currency, we expect to drive both pricing and share gains. For Q2, we expect print revenue to be in line with normal seasonality. We now expect print operating margins for both Q2 and the full year to be near the top end of our long-term range, with our focus on profitable unit placement and incremental cost discipline, helping to offset the impact we expect to have in PS margins. Beyond the segments, we expect both non-GAAP OI&E and corporate other to be roughly flat year over year for the remainder of the year. Factoring this all in, we are maintaining our annual non-GAAP diluted earnings per share guidance range of $2.90 to $3.20. Given an increasingly challenging operating environment and the time it takes to fully implement our mitigating actions, at this point, we expect to be closer to the lower end of our guidance range. We recognize that the environment remains fluid, and we are pulling every lever available to offset these unprecedented headwinds. For Q2, we expect non-GAAP diluted net earnings per share to be in the range of 70 to 76 cents, and our second quarter GAAP diluted net earnings per share to be in the range of 52 to 58 cents. We are also maintaining our annual free cash flow guidance range of $2.8 to $3 billion. However, consistent with our comment on EPS, given the environment, we currently expect to be closer to the low end of that range. In closing, we are making solid progress against our financial commitments. We have a track record of strong execution and remain confident in our ability to navigate these near-term headwinds while also focusing on driving long-term shareholder value.